everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited. We've got some great questions that already came in. And that's what this show's about, is kind of answering questions about retirement, finances, how to manage money, tax planning, all these types of things. And so, please feel free to send in questions as soon as you want. We'll try to answer them live. You can send them in via email at the Ask Tom at talkmoneywithtom.com. Address that you see there. Also, you can put it into the chat if you'd like, and we'll try to answer those live, see what we can come up with. But we believe that education is an important component of kind of having a successful retirement, at least financially, and so that's why we started this channel. And so you can go to the channel. There's over 1,500 videos on there now, and check that out. Subscribe if you. There we go. Just a little technical difficulty. We'll be back in a minute. There we go. All right, thank you. This is a live show, just so you can tell now, without the, preview of being able to have it all, lined up all the time. Sometimes we get some mistakes that happen and what have you, but looks like our hard drive had some trouble, huh?
Yeah.
Yeah, it's a nice stage set, but it takes a lot of computing power. So anyway, you can subscribe to the channel if you'd like. Hit the bell button to get notified, and then of course you can set up an appointment with Ethan and I. 30 minutes at your convenience. Would love to talk to you and answer any questions that you might have, on a personal basis. So I really hope everybody gets something good out of the show today. I want to thank everybody that's come and look forward to today's show altogether. We do start the show off every time with just kind of a summary of what we saw happening with the stock market, and it looks like we lost the connection on this part here. All right, well, let's just talk about it.
We're gonna talk.
So normally I share the chart of the stock market, but obviously, the low that we hit back on October 27th was actually during one of our shows, and we've had this just ginormous run up since then. This week, it looks like we're having a good day today, but it's still probably not going to be enough to make it a positive week. And we've had several negative weeks in this run. I've been talking for a while about, just kind of how stretched the market has gotten. We hit a point earlier this week where the RSI got up to 78.
Mm-hmm.
It was at 81 at some point in the past, but it's pretty rare to get that high. And it kind of shows you, just pricing for perfection. And so sometimes it needs to come back down and settle in a bit. And so this week we're kind of bopping along, and then yesterday we ended up with a 1.2% downturn. Really overnight, it was an amazing thing. We were up almost 0.8%, so we had like a 2% swing in about 20 minutes. And it had to do with one of the Fed governors, Kashkari, who's the Fed governor in Minneapolis, and he was saying, hey, I thought maybe we'd do 2 rate cuts in March at the meeting. He's part of the actual Fed governors that puts in what's called the dot plot, and they guess how many rate cuts they're going to have, for the year. But then he said, now that some of the data has come in, I'm thinking maybe it'll be 0, mm-hmm. right? Earlier in the week, we had Bostic, who's the Fed chairman in Atlanta. Now, he's just the opposite. He's normally one of the guys that wants to cut rates more or not raise them as much, so he's what they call a dove. And even he said he didn't see more than maybe 1 rate a cut in the fourth quarter, actually. So again, you got to remember the market started off with the year with an expectation for 6 rate cuts.
Yeah, it kind of came down to 3.
Now it's down to 3. It's still at 3. And the market's having to adjust to this reality that the Fed might not be, lowering rates as soon, because they were thinking March originally, right? Mm-hmm. And when we say the market, there's a futures market basically that bets on, where the rates are going to be, coming up. And so it's actually, the market has been more accurate over this kind of run up in interest rates than the Fed has been, but not this year. At all. And I thought the 6 rate cuts seemed like a lot. We talked about that originally too. And I've mentioned many times, beginning in early February, that I wouldn't be surprised to see no rate cuts this year at all. And the thing that I think is important to understand about these rate cuts is that if they're cutting rates, it's usually an expectation of some softness that's going to be coming at us,
Yeah,
right?
the economy has to slow down something for them to actually cut the rates.
Yeah, they have a very tricky job because, they're trying to look at kind of current data for what's happening and then project what's going to be happening in the future. And the reason they have to do that is because the changes in rates take 3 to 18 months to have an impact.
And they're also hunting for this kind of Goldilocks zone. You want to have a growing economy, but you don't want the economy growing too fast with rampant inflation.
Yeah, exactly. And we're in that zone, and honestly, for me personally, if the rates don't change, I think we stay in this zone. The Federal Reserve has, a pretty poor track record, and not all to their fault because it is very hard to do what they're doing. But, the 2000 downturn came after 19 rate increases. So obviously you look at that and think, okay, maybe they overraised rates because the market dropped 45%. We had 21 rate increases trying to slow down the real estate market that led to the 2008 downturn. Market dropped 57%, probably overraised rates. And they end up having to go the other way drastically. I know in 2008, they actually went down to zero, essentially, just like they did during the pandemic. And so pandemic, they were criticized for keeping rates down too long, even though inflation was picking up pretty rapidly. They were talking about it being transitionary, and it's just a quirk of the pandemic. They probably weren't completely wrong, but transitionary and what they were talking about was in months, and it's taken years.
Yeah.
And so they had to raise rates a lot. And so the fear is, of course, that they lead those rates up too long and that we end up with a harder recession than we might have, or we might not even have a recession at all. So that's where the market's looking, and that's a big piece of what's happening. Now, what I've been saying all week in my daily videos is that I don't think this part of the market is that big of a deal. I really don't. I know the market dropped 1.2% and really had like a 2% turnaround yesterday based on some comments. So it makes a difference on a daily basis, but then the market kind of regathers itself. And part of that evidence is that the stock market is up over 9%, almost 10% now in the S&P 500
it
year
could
to
be
date.
people looking for an excuse to kind of take some profits in a
Yeah,
sense.
yeah, exactly. And it does, doesn't take much, right? Because we've had such a stretch and people say, okay, I'll take some of that off the table. And so, we've already had a market that's adjusted from 6 rate cut expectation to 3, and we had almost a 10% quarter, right? I mean, so I don't think that's going to be it. I think the driving force is going to still be some of the basics of, hey, what's happening in terms of earnings, right? How is that going? So far, that's been going pretty well. Earnings aren't spectacular, but they're better than expected, and so the market keeps going. And they are spectacular in certain areas. NVIDIA's earnings is still really blowing me away.
We've seen some softness in certain industries. Like some discretionary industries have been showing weakness.
Yeah, but if you kind of line up like all the things that are happening, earnings expectations, have actually been going up right now. So, the analysts are seeing something in these companies, going forward where they're expecting them to do better. And maybe they're just trying to catch up because they're always, seem to be at lower expectations than what actually happens. But, we've got consumer spending doing pretty well. Consumer sentiment is high also, which is kind of interesting. You've got, the artificial intelligence, group that's kind of running pretty hard right now. You have some broadening going on too, which is, I think, very important to understand. If you look at last year, it was technology was the key piece, and it was fairly narrow, right? And that's the way they start. And if you're going to continue to have, good growth, you should see some broadening of that. And so now we're seeing, more and more stocks are hitting, all-time 52-week highs.
Yep.
The S&P 500 is starting to see a spread outside of technology. Matter of fact, the leading in areas right now, if you look at the S&P 500, are with technology, communication services, companies like Meta, and industrials, right?
Yeah.
And these are all like categories that are doing better than the S&P as a whole. So they're leading the S&P so far this year. Technology is actually, if you use the S&P Spider XLK, which is an ETF of the technology companies on the S&P 500, that's up about 7.6% year to date versus the market, which is up more. So
yeah, you have energy, financials, all these sectors are running above.
Yeah, that's
S&P
right.
500.
And I think just as a key point here, this is something we've learned over the years. But you have to be really careful of kind of chasing after these things because we're having a pretty good rotation right now. And so maybe you had a lot of technology and you're seeing that kind of underperform a little bit, you know. And what you really want to do, in my opinion, and this has worked really well for us, you want 75% of your portfolio, both 75% of your stock portion and 75% of your bond portion, in broad ETFs, like Vanguard Total Stock Market Index that covers the entire market, for example, or even just the S&P 500 that at least covers a pretty big chunk of the motion of what's happening in the market. And then you take, your other piece if you want to try to outperform the market or guess somewhere things are going to go or play momentum like we do. So the other 25% is for that. And the reason you want to do that is because of this, what's happening right now, this rotation that's happening that's very, very dramatic, actually, away from what was kind of working so well last year into other areas that were actually pretty poor last year. Energy was near the bottom last year, and now it's at the top. And that rotation is hard to keep up with. I remember 2021 was especially violent in the rotations that were happening. Very, very difficult to keep up with that. But if you have 3/4 in the market as a whole, you just made 10% in a quarter on that S&P 500 ETF or what have you. So, and maybe you didn't do that with some of your other things. So keep your bets, what we call our targets, at 25% or less, and you'll do a lot better because the market as a whole does well, right? Mm-hmm. There are times when we get enough signals, like a primary, we look at the primary wave of the market, right? Primary direction, and so is it up or down? We got a checklist for what that means. Where's the 50-day moving average versus 200-day moving average? What about highs versus lows? Are we setting new lows over and over again like we did in 2022? And so, those signals come late. We're not at the top when we figure those out, but they're not at the bottom either.
This week we had a change of our signals too.
Yeah, that's right. We'll put up the signals here. So we've got, for the first time actually in a long time, our fast signal on the stock market is now yellow, right? And mainly because, we're having this particular downturn as things happen. But the fast signal is meant for things that are like an IRA or what have you, where you don't really need to worry about taxes. And our slower signal is designed for those kind of taxable accounts where you really want to kind of buy and hold for the most part. And at this point in time, the signals for us, when we're in a primary upward direction, they're just informational, all right? Mm-hmm. When we are in a primary downturn, they're actionable. We basically make moves. So, for example, if we have a yellow, we would be moving into things that had a standard deviation that was equal to or less than the market, right? Mm-hmm. Trying to, utilities, high dividend paying stocks, those types of things. Right now, we're doing our normal rotation. We got our big list of ETFs, and we're kind of moving, and this is for our targets. And I think, today's motion coming back up might get us back to green here pretty quick. Let's look at the bond signals, though. That's a totally different area. The bond market's getting hit again today. And so we've had, kind of yellow-red signals on the bond market for, all year, really. And so we're at a red signal on the fast and yellow on the slow. And so, again, you still want, that's a primary direction, still up in this particular case, but just barely. And you still want to be, in those broad market bond funds, like the Vanguard Total Bond Market Index, the ticker symbol BND is a great example of that. But for your targets, you probably want to have lower standard deviation pieces and whatnot too. So anyway, that's what's happening right now. This week has been, I think, a good week personally. I actually, strangely enough, relish the times when a really hot market is taking a break. Because the one fear I have, I saw this before, we saw this in the 2000, where it just gets so high and it gets going so fast that all of a sudden the snapback scares people, and it becomes this momentum thing to the downside, and it's a lot bigger downside than it might have been if it just had taken some breaks along the way. I like the more consistent market, but the market averages between 10 and 11% long term, right? Really long term. The S&P 500 made 10% in the first quarter, half of a 24 to 26% gain from last year too. So not unusual to see some kind of slowdown here. And the thing I've been talking about multiple times, I'll keep saying it because I think everybody needs to be prepared. And we had that 24 to 26% return, last year. We had a 10% downturn last year. Still made that much money. In 2020, we were over 20% for the year, but we had two 9-10% downturns, September and October of 2020. So you can have a 10% downturn in a really good year, and I actually think that's part of what makes it work in a way, right? Things get down and there's some profit taking, and then all of a sudden people are shorting the market, and so when you short, you're selling stock, and then it gets to a certain point, and the buyers say, "Hey, that's a great point. I want to buy."
Yeah, they see value.
They see value. It starts to run up, and then the shorts are covering, which means they're buying stocks, and that's how these things work. So don't worry too much here, because I feel pretty strongly, we'll have some type of a downturn, but it doesn't mean we have to. We did not have that in '95. We had a whole year of run up. But we weren't coming, 94 wasn't a 24% year. Matter of fact, as I recall, 94 was like a 4% year. So we are coming off of a big base, of a big motion, but we're not overpriced, which is interesting. We can get stretched using that RSI indicator that I presented last week, where the market can get too far advanced, on a short-term basis. But when we look at the price-earnings ratio, I think it's around 18 right now. That's kind of average, actually. I mean, it got to 45 at the end of the 2000, run up. So I still feel like there's a long ways to go here. There's so many indicators showing more breadth and more momentum. And then when we have this much momentum, here's what's happened in the past. We've ended up with a higher market 12 months from now. So it's very likely we have a higher market 12 months from now, unless we have one of these kind of weird things that happens, right? I mean, there are geopolitical scenarios that can happen out there, that could reverse course for what we're dealing with here. But take those out for the moment, and you just look at what's happening with the market and how it's moving. It's a giant ship. It's really hard for it to stop at this point, especially with this much momentum. So this market should continue to go. And so today's was up about 1%. When the show started. So that, I think that's pretty good. I'm pretty happy with that. So we'll see what happens. Thank you for listening to this week's summary. And again, we'll look at this again next week. But good time to be an investor. All right, let's start with our first question.
How do you balance between large, mid, and small cap, and also growth versus value with ETFs and mutual funds?
Okay, so I often get asked to help set up a portfolio for somebody's 401k.
Yep.
Right, and so 401ks have a limited list of what's available on there. And so what I do is I take the Vanguard Total Stock Market Index, and there's a mutual fund version, several versions of that, but the ETF version, ticker symbols VTI, that incorporates, I think it's 98% of the stocks on the U.S. stock market, 4,300 and some odd stocks, right? You can find a breakdown for how much is in large, mid, and small cap. You can basically just Google it, and Morningstar has a 9-point grid that you can look at. And so let's say, for example, small cap is 8%, right? Yeah. So I would, if that 401k didn't have the Vanguard Total Stock Market Index, I would go say, okay, I'm going to do of my allocation in stocks, right? I might have allocation in bonds, but of that allocation that I have in stocks, 8% might be going into small cap, right? For example, if it's a 50-50 stock bond, I'm putting 4% in total, right? But so I'm just focusing on the stock portion. And then, what's the mid cap range? It's probably in that 10 to 15%, maybe even a little higher. And then usually it's about 60 to 70% large cap. And that's the way the market is run right now. And so Vanguard's philosophy is something that I don't disagree with at all, which is just you want to buy the market in the capitalization that the market is currently in.
Yeah, so if you want a really quick, simplified, you can think 70, 20, 10 kind of as a rough breakdown.
That's a good one, actually. That's pretty much right on. And so, some people can skew that a little bit because they feel something, is happening. But for your core holdings, when you're trying to balance out the capitalization of your stocks, that's because oftentimes that's what a 401k, they'll have some kind of large cap, some kind of mid cap, some kind of small cap, and then they won't often have that broad thing.
Yeah, and so if you're thinking about growth versus value too, you can kind of go with the indexes just to get your broad market. So you have your general, and then that's you can start to over target or overweight positions too. Say, I think small cap value is cheap, so I think I want to slightly overweight that. So maybe in my targets of my portfolio, I'll add a little portion of that.
Yep, yep, exactly. And so I think it's a good question. You know, it's that, but that's the way to do it. Again, you know, Vanguard's philosophy is that the market is where it is for a reason. You know, Apple, Microsoft, Nvidia, whatever, are all big because they're well run and they do a good job of managing earnings. And some of these smaller companies might be big growers, but they might not. So you essentially want to buy the market as it sits, at least in your allocations, and then maybe you have some portion of what we would call the targets that you're kind of pushing into different areas. But you know, in relationship to how do you figure out how to balance out, you know, large, small, and mid cap, I would take a look at VTI and how it's balanced and kind of replicate that. Like you said, 70, 20, 10 is not a bad way to look at it.
Yeah, and say in your targets, maybe we generally overweight U.S. versus international. So you could put in your targets, you maybe have an international developed market fund or something like that too.
Yeah, that's right. Yeah, because you can go to Vanguard's Total World Index, ticker symbol is VT, if you wanted to replicate, and it has, you know, I forgot what it's at now, but it was at about 40% international, and the rest is in the U.S. And so you can kind of replicate that inside of your accounts also, because that's not in the question, but there is a, you know, there's a capitalization, growth versus value, and an international versus, you know, U.S., right? And we just don't have international in our portfolio at this point in time, just because it hasn't had a run for so long, right? Eventually it will, and you're going to want to watch for that because usually it's spectacular when it does start to go, but it's been a really long time.
Yeah,
the last one I can remember is like 93.
It's been certain countries that have been going up
Yes.
and down. China had a run for a while, but
Yep.
now China is kind of in a recession.
Right.
Japan stock market's finally breaking out again.
Yep.
But
Mexico had a run for a while, right? The last couple of years. Turkey was on fire, and then they had that big earthquake and really knocked them down. So, yeah, we don't do those types of investments into the narrow countries. International investing has already got an inherent risk in a currency fluctuation already. You could make money on the international stock and actually lose money as a U.S. shareholder because of currency. It can go the other way too.
Yep.
You know, it can enhance the return because of currency, but it does have a higher standard deviation because of that. So we generally stick with the broad pieces when we're doing international. You know, but that's, you know, those are the pieces you want to look at. Growth value. You can probably find a breakdown of growth value for VTI also. And look at replicating.
it'll be
that.
slightly skewed. Usually, it's always skewed towards growth.
Yeah.
And then value is a little bit smaller.
Yeah, it's not skewed for any like purpose. It's just that the growth companies have grown more, and so and that's not always true either. I mean, value hasn't had a good run for a long time either. And again, we're more skewed towards growth because of that. But again, value will have a run at some point in time, and you want to have kind of all your stocks for a big chunk of your portfolio. And then if you're going to play around and say, hey, we want more growth, then you do that with kind of the other part, the targets and such too. So anyway, that's a good question. What do we have for our next question?
What is financial independence?
Yeah, this is coming up a lot more, right? The comments are normally, hey, you know, we ask about retirement and, you know, retirement age, and well, I don't particularly even want to retire. I maybe want to switch jobs or keep working, you know, because retirement is, you know, a thought process of I'm no longer working at all, right?
Yep.
And rightfully so. That's probably a pretty good definition. But we're getting more and more people that are talking about having some other career on an ongoing basis, or even if they're staying in their current career, they would like to know that they could leave, right?
Yeah, so financial independence is the idea that I don't need to work anymore.
Yep, that's
I can
right.
just leave this current job, and my whatever assets or pension incomes I have will replace my salary, and I can maintain my standard of living.
Yeah, exactly. So I mean, that's kind of, as you were mentioning, that's you look at what financial independence is achieved when you have enough money, combined with incomes that you might be getting, you know, from Social Security eventually, or from a pension,
Yeah.
right? But you got other incomes that could be coming in, like rents or whatever. So you look at that, you look at your assets, you assume some withdrawal rate, and we were talking about this question before the show, and 4% is a number that gets thrown around a lot.
Yeah, I think 4% is a great number if you're just doing napkin math.
Yeah,
If
right.
you're just kind of like, hey, I just want a rough number to shoot for, you could take your salary and say divide it by 4, and that would be kind of how much assets will I need to accumulate to have kind of this break point where I can be financially independent.
You can divide it by 0.04.
Yeah.
Or
So divide by 4.
0.4.
Yeah.
Yeah. So
4%.
anyway, but so it takes a lot of money. Yeah. I mean, there are some sources that are coming in potentially, but if you're looking at financial independence for most people is actually usually being asked before they can get Social Security is what we hear all the time, right? 60 years old or something. But in theory, you'd have to factor that in, because you're eventually going to get Social Security. But Ethan's right. You can do the napkin math. You can do, the 4% withdrawal rate. But in our world, there's a lot of criticism about the 4% withdrawal rate and being careful with that. And of course, we don't really use it. We use Monte Carlo simulation inside of a financial plan, and that's the way to really answer this.
Yeah, because usually when you're just taking your salary and you're dividing by 4%, you don't usually need 100% of your salary replaced. You
That's
need,
right.
because of just taxes and other stuff, you probably could get away with 80% and be okay.
Yeah, exactly. And so this is something we get asked all the time, and we can go in and make the plan, set it up, and show somebody what they would have to do, what they would have to save, what age they could do it. There's different parameters. And, basically we change the parameters until we get to a point where we can show the person what it would take to get to financial independence at some target age.
Yeah.
And so that's been we've been doing more of that with people that aren't retired, in my opinion, recently than I can ever remember. So people are looking at working longer in some cases. We also have the other trend with younger people where they're looking to, retire early.
Way early, yeah.
45 to 55 range. And we have some clients that are really going after that too. So there's a couple different trends happening. It's interesting.
Yeah, it really depends on, a lot of people want to take the foot off the pedal, essentially. They feel like they're burning themselves out by going so hard and want to have, a point where they can do that.
Yeah, it probably depends, ultimately on, your job. Do you like your job? I read a stat once that most people retire because they don't like their boss. So, whatever the scenario is. And so, maybe that's not an issue for you and you really like your job, but you do want to know, hey, what would it take for me to be able to, pull the plug at 60 if I wanted to or even had to, right? Because sometimes it's, somebody gets laid off, can't get a new job. We had that happen here during the dot-com, bubble bursting. We ran into a lot of kind of middle managers that were in that 55 to 62 range. They had a hard time getting back a job, and so, kind of forced into retirement. It'd be nice to know if I was them that I could retire, if I had to, or, what have you. Actually the pandemic pushed a lot of people into retirement at least a few years early.
Yeah.
A lot of teachers, and what have you that we'd worked with that were going to retire in 3 years just decided to retire, after the school year was over in 2020. So that's a good question.
What is a momentum stock, and what are the advantages or disadvantages of using that strategy?
Okay, so momentum stock and even kind of a momentum trading concept is just, the idea is something in motion stays in motion, right, and continues to go. And so if you find something that's in motion, you buy it, and maybe it continues to go and continues to be in motion, and you make money, and hopefully you're making more money than the market even. We use momentum very heavily in our targets. We have a very sophisticated program to kind of identify those as far as that goes. So it's just something that's moving, right? And it's moving at a faster rate than what else is out there. And so pros and cons. So pro, obviously, if you find something that's moving fast in the market and continues to move fast in the market, that's your pro right there. And they're not super hard to find. I mean, this is not rocket science. I think to do it the way we're doing it and really kind of pushing the envelope for how to find them and some of the testing that we do and some of the data, views that we have, and the algorithm that we've developed, it's more sophisticated, but really it's just a matter of, hey, let's say you have 100 ETFs and you're watching for the ones that are really moving, but you have to know a couple things. What do you mean by moving? Like in the last day, the last week, the last 6 months, the last 90 days. So you have to have some, time frame that you're looking at for relative performance. And then, how long are you expecting that motion to continue? Or more importantly, when do you get out?
Yeah.
Right?
So momentum is kind of buy high, sell higher.
Yes.
And so the idea is that the idea is there's kind of like a herd mentality where it's going fast, so everyone else is jumping on the bandwagon.
Yeah, Nvidia would be a momentum stock, right? I mean, it's still high, and if you're buying it now, you would expect that it's going to continue its momentum with the artificial intelligence growth market that they've got and the lead that they've got in that area. And so that would be a momentum stock. You could buy the whole basket of of semiconductors with iShares Semiconductor ETF. SOXX is the symbol. So theoretically, there's a need for these semiconductors to churn through this data and to get AI to work, as well as possible. So that would be a momentum. So the con side is 2021. I can tell you very specifically. I remember, especially the first half of 2021. The momentum was very, very short, and the rotation was violent.
Yeah, you can kind of think about like surfing a wave when the waves are super small and like they just kind of fizzle out.
Yeah, it was more like white caps on a lake because of high wind in 2021. And so it can be a really disastrous strategy in a market like that where there's just whatever momentum was there disappears so rapidly. We were getting down to very short periods of time. You're looking at 2-week momentum and hoping for 2 weeks more, that kind of craziness that happens as far as that goes. So that's one of the cons with that. And that's why you want to have 3/4 of your portfolio just sitting in that broad market. You're playing with the momentum side, trying to beat the market and, add some value overall, which is what we do. We're trying to make up our fee and then some, right? So try to pay for ourselves that way. And we've had some success with it also, but altogether, that's the hardest part of momentum is, how far back do you look, right, for a return basis? If you're looking for something that's doing better than others, and then how long do you keep it? So to me, it's a competition. There's 180 ETFs on our list, for example, and so how far can it drop on that list before we sell it? And so we have an algorithm to determine, at what point it gets knocked off the list, knocked off the holdings, still on the list, and then how far back are we looking, to figure out that piece. So it's really interesting. It's a good question, but I like momentum. I think it's an easy thing to do. The other big version of investing is value investing, right? Just for comparison. And that's where you're looking for things that are just really cheap. And that works very well. Warren Buffett's probably the most famous value investor out there, and he's obviously done well for himself. Although he went from a deep value. Graham and Dodd wrote a book on value investing, and he took
The Intelligent Investor, right?
Yeah, and he was at Columbia with, I believe it was Graham was his professor at the time, and they did very heavy, deep, value stuff, and he had some real bad busts because sometimes something's really cheap because it's going out of business. Matter of fact, Berkshire Hathaway is named after one of the biggest failures he ever had. It was a textile company that he bought. And so, it just, and Charlie Munger came in and they started buying Apple and JP Morgan and American Express and Pepsi. And they were looking at value within these name brands. And so they were buying Apple when Apple was down, right? And that's where things really took off for them too. So a little bit of sort of like a hybrid of growth and value. But value is another strategy that's out there, just as a comparison to momentum.
Yeah, it's just another tool in your your toolbox.
Yeah, exactly. All right, what's our next question?
So I want to pay off my mortgage by retirement. Is it better to make additional payments or put the money into the market? I would sell at retirement, basically this investment, and kind of pay it off in one big lump sum. My loan is at 3%, and I'm planning to retire in 10 to 15 years.
Okay, so that's important. So loans at 3. theoretically, with that loan, assuming that loan was for the home or home improvements, you get the write-off on it,
Yeah.
and assuming you are itemizing, might not be happening. That could be less than 3% net cost to you, right? Could be 2.5 or whatever, 2% even, depending on your tax bracket. And so then you go look and say, okay, now what's the stock market done? And so you're saying 10 to 15 years.
Yeah.
And so what's the stock market done on 10 years and 15-year basis? It's done really well. Matter of fact, I would hazard to guess that it's done substantially better than 2% most of the time. Now, there's always those scenarios where it doesn't. I remember there was one 10-year period that was down, ended 2009,
Yep.
right? So from that time frame, because we had the bubble, dot-com bubble, came down, came back up to almost exactly the same spot, and then the 2008 bubble, crash occurred. And so that's that 10-year period where the market just, it wasn't down much. I've forgotten the exact number, but a couple percent is what I recall.
Yeah.
But over that 10-year period, you would have been better off putting some of that money towards your mortgage. Now, the other strategy, of course, so you could invest it. I would do something like VTI, the total stock market index. But you can also do a mixture, like a 60-40 mixture, right? That has a track record that's pretty incredible, as I recall, just in the sense of 10-year negatives are almost zero.
Yeah, I think lazy portfolioetf.com has a 60-40 where they go back to the 1800s.
Wow.
And there's basically one period. They do a rolling 10-year rolling return. And they do it on each month. And so
okay.
So there's only one period in their history.
Yeah. So that's another strategy also, instead of just putting it all in the market, you could put it into a 60-40 mix. You could use 60% VTI, Vanguard Total Stock Market, 40% BND, Vanguard Total Bond Market Index, and just keep putting your excess money into that. And then like he says, you're going to cash it out and pay off the mortgage. Now, one thing to keep in mind, you will have potentially some tax in there to do that, right? So if you got a mortgage at $1 million or something, it's going to take more than that. A lot of those, good growth stock type ETFs don't pay out much capital gains every year. Just means they kind of accumulate, which should help your tax situation during your earning years.
Yep.
And you might want to, evaluate how you would take that out as you pay off the mortgage. It might, if it's big enough, maybe you don't do it all in 1 year. You do it over a couple of years during the early part of your retirement, depending on how much gain you might have. So I guess the third strategy would be to do half, into the mortgage or early payment, and half into the market of some type, all market or mixture stock and bond piece. But at least you have a lot of options because the mortgage is so low. That's a really big deal. That's a really nice mortgage to have. And it's there's a lot of them out there. A lot of people refinanced at the right time. So it's going to be interesting to see.
It's an arbitrage case. Can I get more money for my investments than I get from paying off the interest?
Yeah, and you have to look at your own personality and kind of what works for you. I do VTI without a heartbeat. I'd be no problem with that. Especially if it's 10 to 15 years, trying to kind of build that up. Because if I have $1 million mortgage, I might only have to put in, if things worked, $700,000 or something, and to pay that off, if I can get the gains from it, and so I can pay off my mortgage with less money versus just putting it into the mortgage. I'm going to put $1 million in the mortgage to pay off $1 million. And so, I'm going to try to use, like he said, some arbitrage there and get the stock market to kind of pay some of my mortgage. I would never do that for less than a 10-year window, personally. I just wouldn't. But I feel pretty confident that over a 10-year period, I could at least get my money back. If I put in 700, pretty darn good chance I'd have at least that amount, by the time I got to the end of 10 years. If you're talking about 15-year period, we were talking about this earlier before the show. There's hardly any 15-year periods.
Yeah, I think if you go back through the market into the 1800s, it's 189 months. After that, any period is positive. So that's about 15 and three quarters of years, essentially.
So that's that's where the market really works. It works long term. There's no doubt about it. You know, anything can happen, things can change, but I'd certainly be looking at that as an option for this particular case. The other beauty of what he's talking about here is that you're doing this monthly, right? You're dollar cost
Yeah.
averaging into that. That's an even more. You're not putting 700,000 today into there, hoping it's worth $1 million, you know, in 10 years or whatever, or more. You're putting it in. Hey, I got this excess money, and you're going in monthly. And if you ever run dollar cost averaging, you know, as a strategy, it's super powerful.
Yeah, that's why 401ks work so well.
Oh, no kidding. Yeah, because you're getting, you know, even a match that's dollar cost averaging in there too, which is beautiful. But, you know, so the market comes down during that 10-year period, you're buying more and more shares with the same dollar amount, you know, and so that's not a U shape prior to needing the money when your dollar cost averaging is actually really, really powerful, because now, even though you're at the same spot you would have been by the time you finish the U, you've made money on all those shares that were below that start spot. So it tends to work quite well. So yeah, I'd definitely be looking at that. But again, that's a personality thing as far as that goes, a trust issue with the markets. You could, you know, do a half and half or something like that too. Wouldn't be a problem. So. All right, so that's our show for today. Sorry for the technical difficulties at the beginning, but we survived. Hopefully you still got something good out of this. We look forward to being able to see you again next week. We are, you know, available for these questions. If you want to send them in during the week, you can just send them into the email address that just popped up there, asktom@talkmoneywithtom.com. To let us know what the questions are, and then secondly, you know, subscribe to the channel. Really, I think there's a lot of resources there. The more you know, the better you'll be, in my opinion. Or you can meet with us if you want to do a, you know, a half-hour appointment with Ethan and I on the phone, in the office, a video, whatever works for you. We can set that up. Our schedule is available online. You can go to the book appointment button on our website and be able to see, you know, what's available and set it up. Look forward to talking to you. All right, thank you very much. Again, we'll see you again next week. Thank you.